Nobody likes bridge rounds. I think the number one thing I would encourage is take more money than your model says you need to take when you have the opportunity to take the money. So when you're closing the round, be conservative on how much capital you need to get to the next stage. And as difficult as it is, and I can't speak from the other perspective, rank your ability to get to the next round comfortably much higher than the pain that dilution at this current valuation is causing you. When you are at the end of that runway and you need to raise again without having hit those milestones, I assure you that dilution is going to be more costly than taking 20% more money right now.
Hello, everyone, and welcome back to this new episode of the Fundraising Insiders podcast, the podcast where we put what happens behind the check and we put it inside the deck. Today, we have a somewhat standard investor profile. Usually we have people that are a million things at a time, but with Abhi today, we're actually going to talk about directly investment from a very interesting standpoint and a new standpoint as well, because you just recently moved to the Bay Area, if I'm correct. So I'd love to hear also how you're settling in and how is this changing because you're going back to the US. And without further ado, Abhi, please introduce yourself. Where you come from? What do you do? What's the thesis? We'll probably talk about the recent announcements you made about the Climate Fund 2. And yeah, would love to hear about all of that.
Sure. Thanks for that intro and thanks for having me. So my name is Abhi Desai. I work with our own family office called Desai Ventures. The office and the rest of my family is all based in India, which is where I'm from. We've been investing there for over a decade, sector agnostically in venture capital, everything from edtech, fintech, logistics, consumer goods, both directly and through funds. My background's a little different. I've always been in kind of climate and energy. So studied mechanical engineering, worked in renewables development, solar battery storage, went to London for a master's in climate change management and finance, and then worked in consulting for a couple of years, climate risk and strategy consulting for financial institutions. Eventually, I decided from an impact standpoint that what I did mattered a little less from a corporate job than where our money went, especially in the short to medium term. And so I wanted to direct some of our investments the family office was already making in VC towards early stage deep tech climate startups. Given the deep tech angle of it, I decided to do that in US and Europe. I was based in London at the time, and we've been now investing in climate for the last 4 years, pre-seed and seed stage, early stage hardware. We've got 22 portfolio companies right now. I'm actively involved on about half of their boards in observer director capacity and try to help them however I can. And yeah, that's us. You mentioned Climate Fund 2. We just announced our second allocation to the space, invested over 24 or 25 in 12 companies. And that's the Fund 2. Happy to talk more about it.
So to make it clear to the audience, because, well, we also try to introduce investors to companies and companies to investors. You are sadly not deploying at the moment, from what I understand, at least not till the end of the year, but plans for the future. Maybe just people stay tuned. We'll keep it there. It's always an interesting moment in the life of the fund to think, okay, I've bargained my chips. Now let's see what's going on. And maybe you want to talk about how you did those investments. I'm going to jump in directly in one of the topics that is very often tackled, or one of the advice I hear from a lot of the investors on the podcast, which is only invest in things you're an expert in. And you mentioned your background in energy, which really shows in the Climate Fund 1 and 2, actually. In both of them, there's a lot of investments in energy. I've seen some stuff on methane, on heating, HVAC technologies, etc. Can you tell us a bit about your approach to making an investment? We'll talk about the whole hardware bit, but you do invest in things you're an expert in. Now, how do you invest when you are not an expert in a company that you're really, really interested, but you're not the exact expert? Do you delegate the due diligence? Do you learn about it yourself? How do you build that portfolio outside of your exact field of expertise?
Sure. So I wouldn't call myself an expert in all the stuff we've invested in. We invest in, deep tech, novel hardware technologies, especially in the last couple of years. And, I've got an engineering degree, so I have a technical perspective, and I do try to dig into the tech as much as possible. But a lot of the stuff that we invest in, I'm not going to be an expert in. And so I'll take a couple steps back. One, I'd say climate and in climate tech is a lens and not a vertical. And so we produce greenhouse gas emissions throughout our different economic activities across the economy. And so in order to decarbonize, we need to make a change and make changes in lots of different parts, everything from mobility to energy generation to industry to built environment. So there isn't a certain specific sector. If you get into, of course, if you specialize in just say built environment, then you can be a expert in that and invest in that. But otherwise, unless you have a team of PhDs and a humongous fund, it's hard to be invest across climate while having expertise in all of them. And if you're investing in pre-seed, especially in the early stage generally, you often come across technologies that you just didn't necessarily have on your radar and didn't have a prepared kind of thesis or market assessment for to place that tech in there. You come across founders who develop novel technology. So it's difficult to have that expertise always from the outset. In terms of how we do due diligence, because given that background, technical due diligence is a very key part of our DD process. One, I will take the time that I can and use my background to dive into the data room over a number of days, send most of the founders that will do DD in a couple of pages of questions, get them back, do a couple of rounds with that. And that I think is the first decent bar in terms of the founders knowing that we understand their technology, we care about it. We want to understand what the potential is and how that technology can break into the market they're targeting. So it's a very core part of the DD process. But there are elements to answer your question, how do we get beyond what we know or I know? One of the things we do is we do try to get experts in or get an expert view when we think it is required. I've used a service called DeepSense in the UK before that has a network of experts that I kind of tell them, I'm looking at this sort of technology. Who do you have in your network that's in there? I'll hire someone by the hour for a couple of hours to get their opinion on it. That's something I've done before in a few cases. One thing I'll point out that's interesting, and I think it's timely, is LLM models are useful. In the time that I've become an investor, it's gone from, that not being a thing to now it's very much a core part of any computer work as you would. And so doing due diligence, absorbing huge kind of files of text and patents, and also, quickly
Sorry, just when you mean models, what models you mean? Like just like generic available Claude, GPT, etc., or do you mean that those services companies that you mentioned earlier have models that are structured for due diligence?
I mean just the available ones. So LLMs generally as a technology, Claude, ChatGPT, etc., are quite useful for knowledge work, as we've all found, I think, and adopted in the last few years. And in a role like venture capital due diligence, where you need to have a broad swath and do research in areas that you may not have known before, I think that's quite a useful research tool, at least for efficiency. Not that it's not possible to do without it. And then the third thing I was going to mention is I think collaborative DD is quite important in this space. Climate and hardware, deep tech in terms of the rounds, I think more than B2B SaaS. I've seen rounds that aren't just one investor taking the entire round. Oftentimes, even the lead investor is writing 40 or 50% of the check, and the follow-on investors are writing the rest of it. And so I've been on both sides of the collaborative kind of DD approach, where there have been investors who are experts in that space, are leading the round and are willing to share their due diligence with me. Part areas like battery chemistry or biology, where I don't have the background, I've definitely leaned on co-investors. And then the other way, I have also written kind of due diligence notes and shared it with investors that have gotten them to get comfortable with the technical risk in that round. So that's another approach. I think that's useful.
I think that what you just said is very interesting for investors that are either have a broad approach when you say climate as a lens and not a vertical, but some are climate agnostic in the sense that they invest in everything that touches climate or everything that touches carbon reduction, but they don't necessarily have the expertise. Or sometimes you have angels and the teams are limited. So what you just said about co-due diligence is actually quite interesting. What would you advise to people who don't necessarily have those experts, etc.? How do you approach co-diligence? Is it something you just ask to the company you're investing in to know, hey, what are the other investors that have put a term sheet? Are they willing to share their due diligence? How do you kind of do this? What would be your advice for people who are maybe first-time investors or angel investors who are trying to expand beyond their expertise and want to get that external insights? How do you approach it? Is this something, I don't think it's something you pay, but how do you engage in this kind of discussion?
Yeah. So first step I'd say is, if you're interested in the space and genuinely want to learn, this is a deeply collaborative community that has a lot of voices that are public about how they're thinking about things. I'd say dive into this on LinkedIn, or there's companies like, I think, Sightline Currencies, they recently got rebranded as, that puts out reports that says, what is the latest in this market or that market. There's a lot of material out there to read and understand different spaces. Beyond that, yeah, in terms of a specific round, like you said, I think the founder is the first point to touch base with, because the founder is trying to orchestrate the round. If there's someone in the network and an investor who's willing to invest but needs other money on the table, I think oftentimes, and I myself included, have said, we're willing to put in as long as you have a certain amount of capital that you need to get to the next stage. And we'll stay in touch, and they'll put people in touch with us who we can share DD with, or at least give our notes, share our perspective with. And the moment they get comfortable, there's enough money on the table, we've closed the round. So I think that would be the first step. And then there's also different kind of angel networks. If you want to share your expertise as an angel investor, but to keep putting direct checks instead of funds, there are angel syndicates, there are family office networks, there's different kind of structures such that facilitate that collaboration and offload that DD to an extent to some central authority.
I see. There's something that could be a contradiction. Tell me if I'm wrong. When you're a founder, you don't want to crowd your cap table too much. But when you're an investor that don't necessarily have the capacities of massive funds, it's a better thing for you to not be the only one in there, especially if you have someone else that can bring that expertise. So how is it that you can balance the two in a way, if that makes sense?
Yeah, no, that makes perfect sense.
Is there an equilibrium number of investors that is the right mix of family expertise, family office, patient capital, and VC expertise and angel expertise, and etc.? What's kind of maybe your ideal conglomerate of investors, if there's such thing?
Sure. So I'll tackle it in two parts. One, the first one of the opposing kind of trends of there being small checks versus you wanting not to have too many investors on the cap table. I think there's solutions for that. It really comes down to the check size relative to the round of an individual investor and the investor's usefulness beyond the check. I have seen cases in which there's multiple smaller investors interested, and SPVs or special purpose vehicles are a good solution for that, to kind of syndicate investment from smaller investors but have one line at table. I've also seen, previously that came about more as a structure for either angel groups or syndicates to put their angel investors together. But increasingly over the last few years, I've seen structures come up that are founder-led SPVs, such that the founder themselves spit up an SPV that they funnel any smaller investors into. And they'll say, if you have a certain check size, we're happy to have you directly on the cap table. And it makes sense. If you're an angel investor and you're not looking for that degree of kind of updating or board involvement, etc., and you have a relatively smaller check, here's our founder, our created SPV, you can put it in this and you still get the updates and whatnot. So I think there's kind of ways to do that. I wouldn't say, on your second question, that there's an kind of ideal mix of investors to have. It definitely depends very much on your position, on what you're looking for and what you'd benefit from. For example, angel investors, there may be small check sizes, but it's very relevant what expertise they bring beyond the money. And as a founder, let's say you're a first-time founder and there's angel investors who have founding experience before, and you want their advice on how to go about the company's next phase. Or let's say you're going into manufacturing and you have an angel investors that's either your manufacturing partner or has that expertise, and that's what you're trying to get their advice on. So there's different things that angel investors can bring to the table. Family offices, that term varies a lot, but I have seen cases where that patience aspect and characteristic to that capital is quite useful for technologies that are going to take some time to develop in industrial and R&D. And also the potential to follow on, whether that's a VC or a family office, what is their fund thesis and do they actually write the check in the next round as well? So for different reasons, you might want different kinds of capital on the table, but, related to another thing we're, I believe, shortly going to talk about, that's not necessarily always a choice a founder has in the mix that they get on the cap table.
To be fair, it is a bit of a luxury to say, I want that investor and that investor. It's the ideal world for sure. Now, we dove deep very early in the topic of investment and all of that stuff. And now that we are nice and warm on the topic of investment, you've touched points on the hardware side of things. And I'd like to get a little bit of a focus here. You invest in hardware, you invest in climate, you invest in something that is really hard, and you invest early stage. How does one invest when it's hard to get any proof that it's going to work, any traction? And in a technology that shows an impact in the very long term, it needs to be patient capital. How do you combine all of these in the pre-seed stage? How do you build conviction when there's basically nothing to model from?
So as an investor, we have two what we call qualifying criteria. That's one is technology novelty. The technology needs to be genuinely novel, and there's science or technical risk involved in developing their tech. We went into how we do that technical DD, but besides the technical part, there's also another qualifying criteria which we call emissions reduction potential. So coming from a climate background, I am kind of keenly aware of the sectors that we need to decarbonize and what solution and how much will that have an impact on the emissions that we as humanity release or that we want to take out of the atmosphere. And sometimes we come at it from a quantitative perspective, and sometimes there's enabling technologies that'll boost a sector that is already making an impact that is important, even if that individual technology isn't going to be responsible for all of that change. I'll in a second define more. So those are our two qualifying criteria. The remainder, there's a lot else to look at, but that is what you'd expect in any sort of pre-seed investment, founding team, market, etc. And so there's nothing to model. I'd argue back a little bit in that, because the emissions reduction potential point is not just about the technology, it's about the problem you're tackling. So it's very much on similar lines of the total addressable market. Some folks that I know in the space have called it a carbon TAM before, and that's one way to look at it. It's, the problem you're tackling, what's the size of it, not just in dollars in terms of revenue potential, but in terms of how much emissions you could reduce if this technology is scaled. And then just like an economic assessment, you can do an operability, addressability market in that as well. And the second thing on the economics part, I think, yes, there isn't a kind of curve in terms of how will this company grow. And there's more than a pinch of the salt in terms of if someone puts a financial model in front of you at the pre-seed stage, how to look at it. But there is a very important other perspective, and that's the per unit economics. So whenever we look at a company, I'd want to see a techno-economic analysis of the solution they're proposing.
Okay.
And that tells me a very important thing, because yes, we're in the climate space and we want to reduce emissions, but we're not an impact investor at the cost of returns, in that the emissions reduction potential is largely correlated to the market size. So we're going after knowing that this can make a large impact is knowing that it has a large revenue potential, right? And that revenue potential is dependent not just on how big the market is, but that they can actually get into it. And that depends increasing a lot on minimizing or eliminating a green premium, in that if a product is green or other reduces emissions, that's not more expensive than the incumbent, because otherwise it's not going to break in. You're going to be very dependent on subsidies, etc. So what you need to look at, even if there are subsidies in the space, is, what is the per unit economics that you project based on the ways that you are bringing novelty or developing this technology? And is that going to be cost competitive with the incumbent? Are you going to be able to break in? Because even if there's a huge potential, but the fundamental technology you're pursuing doesn't have a route to becoming cost competitive, then that's not as investable. So there's still, I would say, a lot of modeling to be looked at. Pre-seed has its challenges. And so oftentimes the company has to do more R&D before they have that granularity for a TEA or a life cycle analysis and LCA. But there are, I would say, still definitely things to assess, even if there isn't a long-term financial projection to be modeled.
I cannot hammer down enough on enough podcasts the whole thing of you need to have a sturdy business that happens to have an impact, instead of just trying to make impact for the sake of impact. And we'll see about the business later. I'm really glad you add another layer of a no green premium on that canvas. I mean, there is a space for it. The scale is always a thing to tackle. I can't agree more with you. There's something, however, when you talk about the fact that you can still model based on technological assessment, based on an LC, etc. You said that those companies need a level of granularity to be able to get those numbers out. And a lot of the time, when you're at lab scale, it's hard to know the unit economics when you're going to scale up. And one of the big problems we often see, or at least that I've seen with a lot of companies that I've mentored myself, is you get the number at lab, which often is hidden or just irrelevant for various reasons. And the companies say, at scale, it will make sense. And there's an entire no man's land with lots of machine guns, mines, and all the barbed wire and horrible things you can think of. That is the in-between the lab and getting there. Because yes, if you can prove that this is not just a wishful thinking, to take the words of Leon back in episode number 4, and that you can actually prove, yes, at scale, we've done the modeling, it's going to make sense. For you to grow to 10,000 tons or whatever, who's going to buy at 10 kilo, 100, 1 ton, 10, 100, etc.? How do you do this modeling? Is that something that you see often being disregarded by founders? And what advice do you have in the approach from lab TA to scale TA and approaching the market at every point in between?
So I think there's a few different points there, and very important to tackle them separately. So firstly, I'd say, there's this lack of clarity is definitely a challenge, and it's a bit of chicken and egg, because as an investor, you're asking for, I need to know this amount of detail. As a pre-seed founder, you're like, I don't have money to pay someone to do a third-party LCA on my product, right? So that's completely fair. But this is the bread and butter of being a VC, and understanding what are the things that you need to look at to understand the kind of factors that play into the kind of assessment that you're looking at, and or what are the underlying factors that affect it. What I mean by that is, this kind of challenges there both on the LCA and carbon side and on the economic side, but let's take any one of those. And TEA is, techno-economic assessment, is an important one, but at the pre-seed, you don't necessarily have all the factors that'll take to do a complete TEA. But what you do very much know is a reference point. Okay, the incumbent, the status quo, costs X dollars per unit, right? Mm-hmm. And what I'm trying to do is this. What is it that I'm fundamentally innovating that is a challenge for this product that is the status quo, that will enable this cost to come down by a certain factor? And then as a VC, you're assessing how much confidence you have in the team, in their technical ability to actually make a difference in that factor, or innovate in a certain way that'll make a difference in that factor where others haven't been able to before. So it's not just a TEA, maybe at the seed or series A, you're looking at a TEA, or seed, you're looking at a TEA, and pre-seed, you don't have the TEA, but you have the fundamental, what we call in any kind of impact assessment, there's the quantitative approach, you can model it out. But what you also need to have before you can actually make the model is something called a theory of change. What change is this company making and what cascading effects does it have that it has the ultimate impact, and the output has the impact that you're envisioning. And you need to identify that. So I'll take an example I think it's useful to do. Sure. Nutropie is one of our kind of portfolio companies. They are making what they're calling Nutropie cheesable milk. So they're trying to make cheese without animal-free cheese. In order to do that, you need proteins, casein specifically, and those are very difficult to make without, cows or other animals making it. So making it artificially needs something called precision fermentation. And in order to do this, your essentially reference point, and from a techno-economic perspective, is what does cheese cost today? And what needs to be true for me to be able to make caseins artificially in order to make my end cheese product cheaper than what cheese is today.
Right.
And so without going into a lot of detail, you're at the earliest stage asking, what are they doing that'll allow them to make the input cheaper than what is costing incumbents to do it right now, or will allow them to make it at scale. So you're looking at zooming into different parts of it and asking, is the technological innovation, is the founder appropriate enough to be able to get the technological innovation? Ultimately, whether or not that happens is something you're going to find out. So at the pre-seed stage, the earliest stages, you are going to have to deal with additional aspects of uncertainty. And I'm losing my train of thought, but there was another element to what you asked there, but we can get into it in a second.
I mean, it's interesting because for market predictions, we often talk about the top to bottom and bottom down approaches. There's two ways of approaching the market. Well, for the development and the validation, you're talking about the difference between the start to end approach, which is we're at the lab and then we're going to do this and we're going to do this. And this is how we're going to get to that price. And what you're saying is a reverse approach, which is you start from the end, which is this is the target we want to be at. And those are all the boxes we need to tick. Those are all the milestones we need to hit in order to validate that at the end, we will be at the right place, at the right price, at the right performance. Is this something that you have within your own personal framework as an investor, the way to recoup the start to end and the end to start kind of frameworks, and it's something that you validate and it's part of your investment decision process?
Yes, in terms of that's the kind of fundamental ways to look at a techno-economic analysis or a theory of change impact assessment is you got to do it in the context of the market and where you get to. But to your point earlier, getting bit from here to there is very important, and you can't just assume that your assessment is at scale, and when this translates to scale, it'll all work out.
The trenches, the pilot facility, the semi-pilot, the pilot plus, and all of those intermediate steps. And who's going to buy it?
So I think there's a few ways to do it, right? There's different technologies and they will have different pathways to scale. And I think there is a certain thing of appropriateness of the capital to the kind of technology you're investing in. For example, even though we're doing deep tech hardware, we are not doing certain things like we are not going to be unlikely to invest in nuclear fusion. Why? Because we're writing a certain size checks and you need a lot more capital than our check would be relevant for in order to make that technology and scale that technology. You're not going to scale nuclear fusion by going out to contract manufacturers that are making tiny quantities of nuclear fusion before you can make it at scale. You're going to need that factory. And so there are other technologies, though, that can have a more capital efficient pathway to scale. Maybe you don't need to start with your own first of a kind facility. Maybe you can produce your equipment with a contractor and have maybe a little high per unit cost, but get to market before you put up a multi-million or multi-tens of $1 million facility to actually produce it on your own. So I think, yes, you shouldn't assume that you'll get to scale automatically, but at the same time, it wouldn't be realistic for a pre-seed company to know for sure how each step would go in order to get to scale. I think what is more important than having the nth scale figured out is to know what is a most capital efficient way to get there, to be clear about that pathway and the scale of capital you will need in order to get to the next phase and the phase after that, and to court and secure the appropriate kind of capital and amount of capital in order to get there.
This is a kind of reflection that's kind of deep in the due diligence and in the founder's mind. It goes deep into understanding what they're doing, where they're going, etc., and taking into the equation everything. How do you get an investor's trust on topics like this in the first couple of minutes? Because it seems like those are very detailed things that you get on your third, fourth call when you go into due diligence, and okay, how are you going to get to that scale? We're going to go, etc. It's hard as a founder to convey that level of detail in the first call, especially when you just want to have, your first interaction with a VC or with an investor. The ambition is just to get a second call. And then for the second call, the objective is to get to the third call, and eventually it's going to be to get to the check. But as an investor, how do you advise founders approaching detail like such without doing it too early, not doing it too late, making the investor understand, okay, I know what I'm talking about. Like, I've got the path secured, trust me. But like, how do you get that trust? We're going back to the whole thing of building conviction in that sense. What kind of format does it take?
I think this is an element which, to your credit, you guys work on, and I think is very, the core of being an early stage founder, and the ability to pitch. The ability to pitch well, have a crisp pitch that is not just inclusive of all the slides, being able to pitch without a slide that can actually communicate your message clearly. I think the trust element is not necessarily laying everything out in front of the investor, but the investor understanding that these are things that you have already thought about or are actively thinking about to solve. So let's say in the first deck, I see a slide that envisions how they scale, what the steps in between are, what the contract manufacturing looks like, what the pilots look like, what the demo looks like, what the next stage looks like. And oftentimes, or one way to do it is to overlay the fundraisers with it and where you expect you'll need to fundraise and how much capital you need to get there. Not necessarily that you have all these answers, and there may even be fundamental go-to-market uncertainties, and this may be one version of it. But I think communicating that you are thinking about it earlier on gives the investor a bit of trust. Then you don't need to go into all of the detail. Oftentimes it's what the investor wants to double click on, and then having the answers should they ask for the questions about that pathway. Hey, let's talk about that pathway that you projected. maybe this can go the other way, or what more can you tell me about it? Well, then you go into further detail. But I think to your point, how do you do it in the first call? Well, you mention things maybe subtly in parts of your pitch saying, there's a certain pathway to scale we think we can get there with, et cetera. That shows the investors that these are things that you've thought about. And your answer to when the investor asks about it is, I think, very important, because if you're fumbling for it, if that's not something that you've thought about, that becomes pretty clear, versus if you have an answer for that, possibly have an appendix slide for that you kind of scroll through and be like, here, let me talk you through it. That immediately communicates much more.
So it's not about saying it all, but it's about conveying the certainty or the idea that you know about it. Like I'm telling you, I know how I'll get there.
Certainty.
Happy to tell you more about it later, but I've thought about it. Worry not.
Yeah. Well, I challenge just one word on that, not the certainty necessarily, because at the earliest stage, well, it's unlikely to be certain, and it may, in some cases, maybe if it is
the whole venture world
certain,
is
then
uncertain.
Yeah, it's you're investing in a team and in a founder, and in a founder's ability not just to have all of this figured out. You're not only investing in founders who've done 20 years in that industry and being like, yes, this is the exact way this technology can scale. No, you want the founder to have thought about it, to know that this is an issue, to have a certain plan for it, but you're trusting in their ability to change that plan, to evolve with the company, to maybe when they get to the next phase, if they realize that the phase after that isn't going to work out as they planned, to be able to pivot into a way that it could. So you don't necessarily need to present with certainty, but you need to present with vision and with some foresight as to what the problems will be and have an approach to solve.
Right. Confidence more than certainty.
Yeah. Or foresight. Confidence can be, confidence and certainty can go, yeah, I'm confident this is what I projected is how it'll work. It's not necessarily the right approach. Confidence with humility to say, if something changes, we'll be able to approach that.
I see what you mean. Now, I'd like us to jump into the second part of the podcast, which is our flagship format for you and other auditors who may or may not be listening to their first episode. This is the this or that and yes or no formats. The titling is really, really top notch. It's very obvious. I'm going to ask you a bunch of questions. You just answer option A or option B. If you don't want to answer, or if you want to say both or none, don't worry. There's an unlimited joker card. No answer is considered bad or cheating. You can say whatever you want.
All right.
And then it will be the same for yes or no. So just give the answer and we'll discuss them right after. If there's one of them that you want to discuss, we'll discuss it right after this. Are you ready for this?
Yep. Let's do it.
All right. Let's go. So lead investor or follower, which one do you prefer being?
I mean, most of the right. We've called that a couple of times, but we mostly follow, so I'll go with follower.
Would you lead more if you had the opportunity?
Yes.
Board seat or observer seat, which one do you prefer having?
Observer seat, because if you're in the room, you're in the room. It doesn't really matter in many situations.
Okay. Pre-seed or seed, which one do you prefer investing in?
Can't choose. There's merits both.
It's all right. Deep tech or climate tech, which one do you prefer investing in?
Say the intersection of those is very much where we invest. Deep tech, climate.
Amazing. Hardware or software?
Hardware.
Even if there's a bit of software in the hardware, does it add a plus or not really?
Yeah, we're not at all opposed to there being a software component. In fact, we'd encourage it. But if there's more, I'd say the hardware needs to be there. The software can be there. In many cases, should be there, but it isn't essential that it's there.
There are three main markets that you invest in: Europe, US, and India. Do you have a favorite one? And if yes, why? We'll talk about it later.
So we don't invest in India in the climate side of things. So it's US or Europe. Do I have a favorite between the US and Europe? No, I don't. We've got literally half our portfolio in the US and half in Europe. And we can talk about the pros and cons of those, but wouldn't necessarily pick a favorite.
Nice and balanced. Grant first or equity first? What do you advise for hardware founders?
Grant first if you can get it. Nothing better.
Do you prefer reading the deck first on your own, like it's sent to you by email, or having the call with the founder and then having the documents?
Reading it before. It saves everyone's time. I know what I'm looking for, and there's a lot of filtering to take the call. And trust me, if I read it before and I don't take the call, then it wouldn't have worked out anyway, so it's okay.
What's the most important for you? The founder story and how it resonates with you, or the market size and its potential?
If you're investing in pre-seed, you got to accept the fact that sometimes there are pivots and you're always going to back the founder before you back the certain market they picked at a certain point.
Right. You mentioned family office. is the base of Desai, but you do investments like an institutional VC. You talk about having a climate fund, which is a more institutional structure. What do you define yourself as? Family office, angel, syndicate, institutional VC?
It's a family function. I have it is a family office. And so that is the background that I, explain to, and that is what is available for everyone to see. But we function more like a single GP or single LP fund where I'm a GP allocating our capital. So in practice,
Gotcha.
The experience is more like a fund, I expect, for founders.
What is better for the company's growth? Patient capital or the pressure of hitting IRR metrics?
Depends on what stage of development you are at. If you are at the R and growing that, then certainly that speed and fuel of capital can be quite helpful. But if you're a technology that needs long time scales to develop and have multi-year grants, and sometimes patient capital can be quite key.
And now what's best for climate out of the two?
I stand by my earlier point, it's a lens, not a vertical. So there's both of those in there.
And finally, this might be the ultimate nail in the coffin. The climate impact comes first or financial returns come first?
For me, I'd say impact comes first, not because impact's at the cost of returns, but if there isn't impact, there's plenty of other investors who'll invest solely based on financial returns. The additionality of our capital happens when it comes in when there is an impact potential. But of course, in order to invest, we'll need to see that the company can make money and scale as well.
Gotcha. I'll throw in the last one here. Your mech-eng studies or the climate finance studies that you did after, which one shaped you more as an investor?
The climate stuff helped a lot, forms my perspective, but I couldn't do what I do without the engineering background. I think being able to do the technical ED is super important.
Beautiful. That's it for the first part. We can take a breather. Some of those were easy answers. Some of them took a few more seconds. Lead investor or follower, you'd say that you're mostly following. If you had the opportunity, you'd like to lead more. What comes on top with being a lead? Is it just the control over what you're doing, or is it just the ability to deploy more and support the company more? What's the kick you get out of being a lead rather than being a follower? Does it just have to do with your interaction with the company or also your interaction with the other funds?
Sure. So we have done both in that so our check sizes are 250 to 500K USD. At pre-seed, we have co-led in a couple of times, and as a seed, we're always following because the check size usually isn't enough to be setting terms. In the times that we've co-led, I think, we have made a slightly bigger difference in terms of the round than just our other difference in terms of Friday capital or the help we can give afterwards by helping that round come together more than we have in times that we followed. And I think that is what I see as a potential impact and additionality of the capital that we can provide as a follower investor. These are challenging times in terms of the fundraising environment. Yes, climate tech rounds are oftentimes heavily syndicated and there's lots of different investors. What we see in our portfolio companies trying to raise follow-on rounds is oftentimes that they're lacking a lead investor. They have enough investors they talk to who say, yes, we like the company and we'll invest as long as someone's setting terms. But oftentimes they're looking for that lead 4 months at a time in order to close a seed or Series A round.
So it gives you the ability to maybe unlock those cool projects you want to see.
Yes, and it's putting the money where your mouth is, right? If you have the ability to do this due diligence and if you have the conviction to take a position, then it would be useful to have the check size to be able to say, yes, we have the conviction, here are the terms we'd invest in, as long as you have X amount of more capital, which still leaves the onus to the founder to go find follow-on capital that'll come alongside us.
Gotcha.
But then, make that much more difference in closing that round.
I do want to touch on the second question we had, which was on board seat and observer seat. As a ex-founder, we had one of the investors that really wanted to be on the board. And we said, well, you're not leading. There's already a bunch of people on the board. We can't just keep growing the board massively. And they said, okay, can we at least have an observer seat? And as a founder, we thought, well, you don't really have voting rights, but you're in there. Okay, cool. Like it was an easy concession for us to do. You said that you prefer being an observer. Why?
So of the 22 companies, 11 of those that have some board role in, 8 of those are observer seats, 3 are director seats. Given all the board meetings that I've been on in the recent times, or the last few years, boards often work on a consensus. There's very few board votes, which are of course the crucial ones, where there isn't a consensus. Oftentimes has to do with very important things and possibly with shareholding, preferred rights, management teams. And those are the crucial times when the difference matters. But oftentimes the discussion you have and the points that are raised and matter a lot more than the final vote casting. Even at the times when the vote isn't a consensus vote, you know what the votes are going to be when you have that discussion, not necessarily just when the votes are cast. So a lot of the difference that you're making and the help that you're bringing is oftentimes provided as being an observer rather than necessarily being the one to cast a vote.
Right.
And so also two of the three board seats that are held aren't because of the rights of the shares that I hold. One of them is appointed by the founder, another is appointed by the lead investor who's not taking the board seat themselves. So it's about, I guess, being a director has a lot more than being an observer rather than just those votes. There's a lot of administration that goes with it. There's some liability that goes with it. So if I can provide 80% of the help that I am there to provide as a person who has a voice on the board as an observer, then I'd rather do that than take the additional administrative burden, especially if I'm not a critical player on the cap table who needs to have that vote say and director consent rights of being a director.
Does the investor read of that thing? What about the way that a founder could read this? I mean, sometimes founder, they don't want to have too many people on the board. They want to retain the ownership and the decision making. And what would be your 2 cents on founders not necessarily wanting too many people on the board, even observers? Because even though they don't really vote, as you said, they do have a word in the whole discussion. So what's your take on this?
Yeah, no, I mean, it's a very fair point. Too many cooks in the kitchen doesn't help. And I completely agree that you shouldn't see observers as something that it doesn't matter and you just have as many observers, because ultimately that affects the discussion and the quality of the points and the advice that you get from that room. So I wouldn't advise just be agreeing to observers loosely. You should be selective about that. The way I've approached it is we think we can help, and I think I can help in my participation in differently at different stages of the company. Maybe it's, technical sounding board at the earliest stages. Maybe it's strategic. Maybe it's even revenue and go to market at later stages. And maybe it's fundraising and introducing you to funds.
Gotcha.
There's several times that I've taken an observer seat, but the founder has retained the right to take away that observer seat after a certain period of time. And, I've said, okay, if I can be helpful in the first 12 months, we'll figure it out after those and you can keep me on. If not, I'm happy to take a step back. So we're there to help. And if we're not being very helpful, we're fine to take a step back.
So it's a matter of strategically assigning those seats and not just take it because you just want to hear about it.
Yeah, absolutely.
Gotcha. Then we had pre-seed or seed. You said you couldn't really choose between which one you prefer. I guess they're just different.
Yeah. I mean, look at the hardware and deep tech side that we're investing in, pre-seed and seed. There's several differences. Most importantly, the TRL, the technology readiness level of the technologies that we're investing in. Pre-seed is earlier stage. It's investing in the company and seeing if the founder is able to get that technology to the next stage. Seed is a little more closer to commercialization. And so it's more about, is that technology getting the first kind of traction in terms of pilot revenue and et cetera, that they need to get to the next stage. There's so many things that are different, and our investment plays a different role. We have different check sizes for the rounds. So both are making an impact and furthering that technology development of crucial technologies in very different ways. So I wouldn't choose either or. I think we want to keep doing both.
Gotcha. Okay. And finally, this was maybe the question that you had started to open on. It was going to go a lot further. I asked about India, Europe, and US. Although the climate investments are done in Europe and US, you also have some investments in India. But let's talk about Europe, US. Yeah, 50%. It's nice because you actually have the tools to answer this. You have 50% of the investments in the US, 50% of the investments in Europe. Major differences, major similarities. Floor is yours.
So the reason why we are not investing in India, even though it is where the family office is based and where we've had a previous investing experience, is because I wanted to invest in deep tech, fundamental novel technologies, hardware. And at that stage, oftentimes there's almost as much non-dilutive capital as there is equity capital. And there's a lot of grants that are necessary at the early stages of those technologies to take them from the lab to the benchtop to the field. And so that's why we're focusing, and from a bandwidth perspective and from that perspective, we chose to focus in the US and Europe as opposed to India, because there just isn't as much grant capital out there. And so grant capital does make a significant difference. There's differences between that in the US and Europe as well. There is quite a bit of grant capital, at least till a few years ago, available on both sides of the pond from governments specifically focused on different climate technologies. That has reduced in the US to a certain extent. If you compared it 4 years ago, US had a lot of grant capital as well available to all these climate technologies. In fact, some of the grants that came from the Department of Energy or ARPA-E in the US, which are the big grant writers, oftentimes happen to be significantly larger than the government grant sources or other sources in Europe. So if you need to build fundamental capital intensive technologies, it was sometimes better to do that in the US.
I see.
It is decreasingly the case because of the current political climate and how those grants aren't necessarily flowing as much into climate tech in the US. It isn't dry by any means, but it is a significantly different landscape than it was a few years ago. So that is very much a change to think about, to consider. On the market side, there's definitely significant differences as well. This is something that a lot of investors, regardless of what sector they're in, will tell you. Once you've got a product that is in market, it is significantly more straightforward to scale that sort of product in the US purely because of the size of the single market than it is in Europe. Taking it from one to different jurisdiction, getting it right through, hoops in terms of regulations and actually selling it. So there's a significant difference that does make, but not just on the scale of it, the type of demand that comes through is also quite different. Europe has a lot of regulations to do with climate. It has the compliance market, the ETS scheme in mainland Europe, in the EU, etc. So there's different demand pools, versus in the US, it is a lot more cost sensitive. For example, I'll take a space that we've invested in methane monitoring technologies, and those get sold both in the landfill space where there's emissions of methane, especially, as well as oil and gas. Well, in Europe, the driving forces right now are these methane regulations and emissions limitations, especially those which are increasing over time, that are forcing local and increasingly importing oil and gas companies to follow certain regulations. And that is what's driving demand. Versus in the US, we're seeing companies selling that in some states and regions are still, the part of the demand is because of certain regulations, but it's also significantly due to cost. There's upstream oil and gas companies, or gas companies specifically, that have significant economic incentive to limit the amount of gas they're leaking, and hence the money they're saving. So there's different drivers of that demand between the US and Europe.
Do you have I'll cut this out. Do you have a take on the prosperity and long-term potential of those different demands? Because the regulation can change and the push is over, whilst if you're cheaper, you're cheaper. People will always want you.
Yeah, I mean, yes and no, in that there's critical points at which these regulations are, especially the ones oriented to novel technology, are designed for, right? They're not designed to always be the single source of demand. Oftentimes, they're designed to be a bridge that facilitates the economics of certain technology. If you see solar or wind, for years, first Germany and then the US subsidized their deployment through different mechanisms. And at this point, solar in much of the world is significantly cheaper than many gas or coal, etc. So just because the certain amount of demand comes or is enabled by certain government policies, I wouldn't say means that that market is just bad and you need to go to one that needs to prove economics from day one. Proving economics from day one can be a significant barrier when you're trying to break into an incumbent that has so many economies of scale that it's not going to be possible. And then you do need some incentives to actually prove out that economics.
Okay.
So I wouldn't say one or the other.
They work hand in hand in that case.
Yeah, absolutely.
I see. I'm getting conscious of time. And I think for once, we really had pertinent discussions on the this and that. I think the yes and no segment, I'm rereading the questions I prepared. I think we actually covered most of them earlier. So it actually saves us time. And it means that the discussions were good. There is one more topic I still want to maybe dive a little bit deeper into, because it's really the big thing of this episode, is that you have this thesis with deep tech, hardware, climate, early stage, which is it sounds like the Thanos globe. You put all the stones of what's impossible to raise in, and you decide to invest in there. So let's talk a bit more about the traction you were talking. We were talking about this earlier, that there's not necessarily zero metrics to assess whether a pre-seed, pre-revenue, hard tech, etc. company has to offer. But what is the kind of traction that they can show today? Say you don't really have what it takes to have the final product at the final price with the final process. And it's really hard to get contracts, especially when as you said, some technologies are out there with a unit of scale and none of the big players are going to buy it unless you provide 100,000 tons, or if you can provide for the an entire country they provide in. So it's hard to get those contracts, hard to get those revenues to show this traction. What are the different forms or shapes that traction can take that aren't necessarily super obvious to most founders, or that maybe you see some deals and you think, hey, it doesn't matter if you don't really have like X many revenues or millions of revenues. Traction can also take other forms and shapes and formats. What would those be? And what are the advice that you can give to those founders you're susceptible of investing in, or fellow investors are susceptible to invest in?
Yeah. I mean, look, in technology, novel companies or companies developing novel technology, it starts with the team, right?
Okay.
Why am I buying that this team can develop this technology in order to break into this market? And is there a seed there, right? If a founder comes with saying, I have a PhD in this and this other founder has an experience in this, and we're just going to invent some technology that we have decided to do 2 months ago, and this is what we're raising funding for. It's difficult to invest without knowing that in spite of their background that they'd be able to develop that. Oftentimes we're looking at researchers turned founders who have some basic seed of technology, whether they spent their PhD doing that, even if that means a university has the IP that you need to license, or in some cases that they actually worked on that as a company with kind of a friends and family around, and then file their IP or have some IP ready to file that they've developed in recent times. So oftentimes we do look for the very seed of the technology, even if they are at a TRL. We are not going to invest at TRL 2. We're going to invest likely earliest at 3, and there being some benchtop scale. So I'd say pre-seed is still the first institutional round, oftentimes priced.
Sure.
And so it does need to have a certain amount of early traction with respect to the technology before we'd invest. It's not just the founding team that we're investing in. Beyond that, what to actually target in terms of milestones and traction at pre-seed in order to get to the next phase, I'd say you don't necessarily need to have contract offtake, but pilots are super important. And when I say pilots, I don't only mean that the economics of it, maybe you sold it at a higher cost than it takes you, or lower cost than it takes you to make it, right? At that pilot, that's very likely the case. But I want to see the user of that pilot, and maybe it's most likely a very early adopter who's interested in your success, but their response. I want to see, even if there's very few of them, how they experience. For example, we have a few investments in heat pump technologies, but novel solid state heat pump technologies, where there I'm looking at not just the fact that it's okay that you did 5 pilots, but I want to hear from the people who installed those heat pumps, as well as the people whose home those heat pumps are in, to understand what is the user experience. So in absence of mountains of data, the quality of data and the feedback is quite important. And then on the same vein, in quality versus quantity, I'd also point to LOIs. Sometimes founders say, here's my data room and here's this folder with all the letters of intent that I have.
There's like 20 of them.
And just like different corporates that you interacted with, where the internal champion is willing to write you a letter, but not really make any other commitment, is not nearly as valuable as fewer of those corporates that maybe piloted your product and that have something important to say in that letter of intent, saying, look, we like X, Y, and Z that this product does. And if this product can get to this scale, then we would like to adopt it. And that doesn't need to be binding, but something specific that says why they like it and what scale that would go to the next stage of commitment, I think is important. The recency also is important. Sometimes you're presenting 2-year-old LOIs that weren't for the product that you're now selling. And so I think when you go out to raise, the recency, or at least it's It doesn't need to mean that you got it just before the round, but that you got it for the same kind of product that you're
It's
looking
still
for the investor to
relevant,
now invest in.
basically.
That's still relevant. Yeah.
Gotcha. Okay. Thank you very much. I think I'm kind of out of questions from everything I wanted to discuss, and I'm glad we could finish with this point, because it's sometimes a hard thing to say, hey, I'm raising, but I don't really have revenues. And it feels like this could be the end line. You just said, well, it's not the end line. There's so much more to it. So I'm really glad for you to share this with us. Now, a question for you, I guess. Is there anything else that you wanted to discuss? A topic that you feel is undervalued, maybe underaddressed in the industry that you really want to share?
Well, I guess we can spend a couple more minutes on this, but there was a question, I think, in the early read that we said we might discuss. I think the funding environment right now is a certain way, and it's useful to discuss what might be helpful for founders in that. I'll take the lead on framing that, in that when we started investing in 22, even, which was the peak, climate tech was all the rage. There were new funds popping up. There was a lot of rounds happening and a lot of money going into the space. We saw some frothy valuations there, but also rounds were easier to close. 25, 26 isn't the time of 2022. Rounds are more difficult to close, take longer to close, and valuations aren't quite as frothy. But apart from the valuations, the difficulty for founders is that it takes longer to close. Now, that's something I advise our portfolio companies on all the time. And that's something I would like founders in the space to internalize more. Unfortunately, as it is, I have found myself advising in the last while that account for 6 to 9 months to market your seed round, account for up to 12 months to market your Series A round. Now, that is extremely difficult for a founder to do when they're raising at max a 24-month runway when they are raising. Because when you're raising a 24-month runway and you're expecting to go out to raise when you have 12 months of runway, well, you're in an extremely challenging position to say, I'll need to hit my milestones in the first 12 months.
Yeah,
right. Which is a very difficult thing to hear and not very practical. I think what sometimes it doesn't quite get communicated is the nuance to that, which is the unfortunate fact of this fundraising environment. You want to not talk to the investors who you're hoping will lead the round for the first time when you're officially launching the round. Mm-hmm. You want to be in some mode of fundraising, even if you're not, say, yes, I'm ready for you to write the check. You want to have warm conversations going with a few investors who are following your progress, such that when you're launching the round, you're saying, here's the latest pitch deck for us, and we're now accepting checks, rather than saying, let me now introduce you to this technology. And maybe that means you're talking to an associate or not the lead person in a fund in those early stages, but at least there's someone in that organization that is warm and that you're in some pipeline for their fund. Fundraising can take a while. One thing I'll also highly encourage is to understand how your company evolves during that time. One thing that I've seen founders fall for is to be aggressive in their projections when they go out to raise and trip over their own projections 2 months into that raise when they should have hit a milestone that they put on the deck. I think you want what you do in terms of progress during the time you're fundraising to be home runs that convince that investor to invest, not to be milestones you haven't hit because of which the investor gets less confident. So I think the reality of the fundraising environment takes longer, and you need to account for the time it takes to fundraise and how things evolve during that time, and not just at one point in time when you pitch the deck for the first time.
So those are the two key things you say is keep showing momentum. Start early. Don't say you're ready, but show, hey, this is where we are today. Next update, there's been progress. Next update, there's been progress. Last update, okay, with all the progress we've done, now we think we're ready. And throughout this phase, try to walk the talk. Just don't overpromise. It's very important advice. Thank you so much for these. Any other advice on this tough fundraising environment? We've seen the emergence of a lot of bridge rounds. See that a lot in climate, where valuations are maybe not stagnating, but because they're not as high as they used to be, the round is more advanced. They're raising more, but at a lower valuation, or at least an equal one to the one they just raised before. And it kind of looks shaky. What does that reflect? Is it just something that trickles down from the fact that, the fundraising environment is harder? Or is it an evolution of the whole fundraising ecosystem as a whole?
Nobody likes bridge rounds. Nobody likes a round that's called a bridge round, but that doesn't mean relabeling it helps. I think the number one thing I would encourage is take more money than your model says you need to take when you have the opportunity to take the money. So when you're closing the round, be conservative. Be conservative on how much capital you need to get to the next stage. And as difficult it is, and I can't speak from the other perspective, rank your ability to get to the next round comfortably much higher than the pain that dilution at this current valuation is causing you. Because when you are at the end of that runway and you need to raise again without having hit those milestones, I assure you that dilution is going to be more costly than taking 20% more money right now.
Right.
So no, I don't think bridge rounds are the new normal, that this is just how VC will be. I think that is, it's not sustainable.
Gotcha.
And trying to avoid bridge rounds is probably the best strategy to navigate bridge rounds.
Okay.
Or I'd say to the extent that you absolutely need it.
Of
I think grants help a lot.
Yeah.
There are cases that I've seen in which, you may not have a lead investor, but you got a significant grant that shows, hey, your money isn't by itself. Your money is coming in with this chunk of non-dilutive capital that is give us the runway to get the next milestones. Those are great opportunities to be able to raise some more money with it.
Gotcha. Beautiful. By the way, quick question on this. There's a bunch of companies that sometimes have reached out to me or have discussed with, and they're saying, there's this grant and we can't really apply because we don't have the match funding, for example. How does that do for an argument to get funding and say, hey, if we get the funding now, it's a bit hard because those grants usually are on very short time scales. And maybe this only works with angels, but is it a valid thing for a founder to say, look, there's this massive grant. It's like once in a lifetime. And we actually think we have a really good shot at going at it if you put in the match funding. Is that a thing? Is that not a thing? How would you see it if someone approached you with this kind of argument?
I think it's a reasonable thing to say this grant is also funding our runway, and so it is complementing the equity capital that'll come in. I wouldn't invest unless that's contractually conditional. So there's oftentimes grants that say there's a difference between approval and deployment, and say you're approved based on match funding, and then you need to show this much equity capital. That is the best time to be raising that equity capital.
Okay.
Not before you won the grant.
Okay, so you need to have the grant that says yes first.
Yeah, and there's programs designed for it. For example, the UK has an investor partnerships program with Innovate UK that is very much, trying to tackle that chicken and egg problem. So regardless of how it is ordered, I wouldn't invest based on your invest would make us more likely to, or would allow us to apply to a grant we think we're likely to win. If I'm investing based on that grant coming in, then it would be based on that grant being approved and this equity capital unlocking that.
Apart from this UK modality, I think is the only one that I've seen. I'm not a grant expert by any means, but is that maybe not a distress signal, but a call for something to change in the way grant funding is, that they could be pre-selection layers, or that if grant structures, especially the match funding one, if the grant structure were to change, they could attract more early stage investment because of the certainty of that coming in. Because right now, if you don't show the monies in the bank, a lot of grants, you cannot even apply to them. So would it be useful if some of the grants could give a preliminary yes, say, hey, from now on, you have like 3 months to get the funding. And if you get the funding, then you can get the rest of the grant. Would you think that this could help deploying both the equity and the grant and have more certainty in this thing? Is that a model that could be interesting?
Yeah, look, this is a topic we can talk for way longer about, because the grant landscape is very diverse. There's various ways in which they're trying to facilitate and various stages at which they're trying to help companies. Certainly in encouraging private capital alongside grant capital is a way to kind of boost the impact that government or other organization is making through that grant. There's other ways I've seen to do that besides just the partnership model. But yeah, I'll put it there. It's, there's recoverable grants, there's government loans that can convert into equity rather than asking for the loan back. There's various models to do this.
So to make it a brief advice for companies out there, don't only look for your typical grant, and ask your local authorities the other types of grants, the other types of non-dilutive or potentially dilutive funding as well that can leverage or increase your capacity, increase your runway. That's always an interesting thing to look into. Abhi, thank you
Absolutely.
so
Take
much.
grants very seriously as a source of capital and
Yes.
put effort and resource behind finding those grants and writing those grants because they can be extremely important.
It's definitely the thing that as an ex-founder, I regret us looking into grants so late. I remember one of our investors was telling us, "Are you looking into grants? Are you looking?" And we thought, the amount of money it takes to write a grant and the grant writers or etc. And then we thought, God, you just get one and suddenly you've refunded for all of them. And the moment we started looking into it, we had like 2.2, I think we raised 2.2 in equity and we ended up raising 2.5 in grants in a year and a half. And yes, it is worth putting resources in having a grant writer. I know it's a couple of grants up front. It can be £3,000 to £7,000 up front for the writing, etc. But think about it. You do it once, you have a really good structure, you have the all of the templates and everything. It's really useful. I cannot recommend grants more than this. And even though it might seem like a pain because you don't know how to write it, you'll learn along the way. So yeah, great advice here. Abhi, thank you so much for sharing all of these advice with us, for giving us the perspective of the investor and especially that specific position that you defined as a single LP fund with a single, and the GP is basically the LP at the same time. It's an interesting structure which gives you some degree of freedom as well. So yeah, thank you so much for all of this. And I don't know if you have any.
No, this was an absolute pleasure. I really appreciate the questions that you came with, and it was a super interesting conversation. Thanks for having me.
Thank you so much. And for our audience, as usual, if you're listening to this on Spotify and you want to see our beautiful faces, head over to YouTube. If you don't want to see our faces, it's okay. It's perfectly fine. And for all of the learnings to be in a more digestible format, we're also publishing clips and reels. You can find that on the YouTube channel and on the Instagram at fundraising.insiders. And for all the key learnings of the podcast, we will be posting that on our LinkedIn and on our website with all of the repositories. So if you want to learn about, hey, what is traction in the early stage? Like we discussed with Abhi, you can type just traction in there, and there should be the segment where we talked about it with Abhi that comes up to you, along with any other we discussed in previous episodes. So look this up. Abhi, any of the networks and social media we want to follow you on? I guess LinkedIn is the main one. You've got your website where you shared your investments recently. Anything else we want to find you on?
No, those are the main ones. I'm pretty active on LinkedIn, so that's the main one.
Beautiful. Then I'll speak to you soon. I'm sure we'll stay connected and exchange deal flow and other crispy advice. And for the audience, we'll hear you in the next time. See you. Bye-bye.